Good morning, everyone. Welcome to this update for global stocks and commodities for the 14th of January. We've just seen a second stunning week in the States. The markets have shot higher, obviously set new all-time highs, and the trend is actually accelerating, as you'll see when we look at the S&P chart and some of the other indices in the US. So it's been the best start to the year that I can remember. History may show that there's been another one similar along the way over the last 20 or 30 years, but I can't remember a better one than this. And I think the key thing is that it's not being driven by speculation. It's being driven by good old fundamentals and a shift in sentiment. And I think all those things have still got a long way to play out. So the key part that I want to deal with in this video is the important one, that the markets are very short-term overbought. They're very extended. And so what is likely to be the outcome over the next couple of weeks, not based on a guess on my part, but basically on what we can read from what the market is telling us. So let's jump in and have a look at that. So in this update, I'm going to be looking at the couple of different ways that some sort of pullback or pause may unfold and what that tells us about the next few months or indeed 2018. So for me, I see it as a bit of a trade management challenge. There's no question about whether you should be in or out of the market. You should be in the market, boots and all, but it's very much how you get into stocks and how you manage the stocks and take profit while you're in there. It's going to become more important in 2018 than it was over the last couple of years. Of course, I'll be looking at the stock and commodity trend updates, and it was a pretty good one for commodities. And portfolio analyst last week, if you want to take advantage of the free trial, this was what was covered last week, how to build an investment position, which I think is going to be of value to a lot of investors. Dealing with currency movements is something if you've got your money overseas, which I strongly advocate. There were some buys and strong buys for America, which continue to do extremely well, and some more on local resource opportunities as well, which is one part of our market that is moving. And there was also a left field buy for Australia as well, which the market is sort of ignoring a bit at the moment, but I think has good long-term potential. So let's just jump in and just remind ourselves of what the backdrop is. The type of strength that we've seen in the 2 weeks since the start of the year doesn't just disappear overnight. It's arising for a reason, and that is that sentiment has shifted quite dramatically from being really downbeat to some sort of mild acceptance stage, and we're now starting to just see the first green shoots of enthusiasm. And that takes a long time to build and develop, and it's not going to disappear in a hurry. So therefore, I would expect that any pullbacks should be fairly shallow and brief. But as you'll see from the chart, when prices do get as extended above the mean as they currently are, then the first 1 or 2 days down could be a bit sharpish. That's also got to be combined with the fact that earnings season started on Friday, and the stock prices have run up in expectation of pretty good results. And if those results are coming through, then there'll be some fairly savage treatment dealt out to those stocks. But at a big picture level, the ducks are really nicely lined up. And look, I've mentioned this a number of times in recent weeks. We've got synchronized global growth. We've got terrific growth in earnings in America, but also coming through, starting to filter through now in Europe as well. We've got the US tax cuts, which are a real game changer for the US, which I talked about last week. And of course, we've now got a shift in sentiment. Now, the other key part of the backdrop is interest rates are on the rise, and this is scaring some people because of some old wives' tales about stocks always do badly when interest rates go up. And whilst that's not untrue, you have to reach a certain threshold before that has an impact on stocks. And at the moment, we are nowhere near that threshold. So it's no cause for concern at this point in time. And as I've said before, it's virtually impossible to see the Fed undoing a decade of concerted work on rebuilding economic strength for them to raise interest rates too quickly. And I don't believe, and I think markets have shown over the last 5 or so years that inflation breakout is not really a problem, because technology has taken so much of the pressure off wages and prices that inflation breakout is less of an issue than it would have been 10 or 20 years ago. Earnings season has just started well. JP Morgan and Wells Fargo reported on Friday with good results. They beat expectations, so that was a good start to earnings season. Looking now at American stocks specifically, the S&P was higher by another 43 points on the week, and the market now, you have to acknowledge that the market's at some sort of short-term risk of consolidation at the very least. And I want to look at two possible ways that we could get at that short-term consolidation, and also what we can read into it. And I'll keep you abreast of this as we go through week by week. So don't be concerned that you're going to be suddenly sideswiped by the market. We can determine a great deal from the way that the market pulls back. So I'll keep you right on top of that. The technology sector, which had a pause in the middle of last year and also another little pause before Christmas, is now back with a vengeance. And the NASDAQ had an extremely strong couple of weeks. And we've seen some really robust price action in energy, probably more than any other sector, along with consumer discretionary. And also the general commodities complex is doing well also. Now, the US dollar is showing weakness again. It's completely puzzling to me why this is the case. As I read it, and I'm no currency expert, but as I read it, I think this is a lot about euro strength rather than US dollar weakness. So I don't believe it's something that's indicating a long-term trend change, because with what they're doing in America, with the money being repatriated, with the strength of the US economy that's likely to flow, it's really hard to see that relativity between the euro and the US dollar going too much further. And of course, this is fed through to surprising strength in the Australian dollar. But again, as I've been doing all through last year, just pointing to the fundamental differentials in interest rates, and I think at some point that's going to really have an impact, and we'll see the Australian dollar tend to track lower. So let's look at some of the American stocks. So we'll start with the S&P, and of course the first things to note are the red 200-day moving average line continues to move up really strongly. There's been no break-in trend whatsoever. The price is accelerating away from it. The 50-day moving average is accelerating away from the 200. So there's no question that this trend is accelerating, and there is no sign at this point in time that that's going to reverse. However, we know that it will, because these sort of deviations above the 50-day moving average just aren't sustainable. And where we're at the moment is as far above it as I can see, going back a long time. In fact, this may be, in the last decade, this may be the greatest deviation short term above the 50-day moving average that we've seen. Now, that's not a reason for you to panic and sell stocks. It's merely saying that we really should just be a little bit more careful about our entries and perhaps some of our trade management. So the S&P finished at 2786, which when you think back, it wasn't that long ago. Back here, if we wind back to, let's say, May of last year, it was trading at under 2,400 points. It was pretty hard to imagine that wind on to the start of this year and we'd be at 2,800 points. I don't think there'd be too many people would have been forecasting that. And certainly that's gone well beyond my expectations as well. Now, I've been trying to find an equivalent period on the S&P that I could show you some different scenarios of how this may play out. That's proven to be quite difficult because this is such an extreme. So I'm going to look at two US stocks that that will indicate how this may play out. So don't worry about what stocks they are. I'm just really pointing out the chart pattern. So this is a stock that you can see clearly was in pretty good uptrend, not as strong as the S&P is currently, because if you just look at the shape and direction of the red 200-day moving average line, it's not as robust, but at least it's in strong uptrend. The price managed to get quite a bit above the 50-day moving average, as you can see. We got a real acceleration, and then we got a sharpish reversal. So a little bit of a gap higher, and then the market turned over short term. That occurred on the 6th of November, and you'll notice that volume had reached a bit of an extreme as well. So this was a real buying climax. We haven't seen that buying climax in the S&P, but I wouldn't be surprised to see it one day next week. Now, this stock then had an ABC correction. So here's the A leg, there's the B leg, the bounce, which almost always occurs, and then the C leg before we took off again. So that's a reasonably deeper correction. The price fell from 64.5 down to 56. And you'll notice that we did get some sustained selling through this period. So not surprising that we didn't just get a bit of a shallow decline. You can see some of the ranges of these candles are quite elevated. And so no surprise to see this pattern play out with a deeper correction. I don't believe that that's what we're going to see in the S&P, but the key things to note here are the range of the daily candles, the fact that so many closes were near the lows, the fact that the volume was sustained at a fairly elevated level. It didn't drop away really quickly. As we saw here in the C leg, you'll notice how the volumes through here are generally a little bit lower than they were during the A leg. So there's an awful lot that you can read into the way that the price chart falls. Now let me look at a different scenario. This is another stock, a Chinese listed stock in America. Again, you can see a very, very strong uptrend. This is a relatively new uptrend, but nevertheless, the price had reached quite an extreme above the 50-day moving average. It happened to occur at a key resistance level, which was an all-time high. And yes, we did get one sharp day down on quite elevated volume. But look what happened after that. There was no follow through. There was a little bounce, but the range of the candles is quite small. The volumes basically deteriorated quite sharply from that peak, and we didn't form a lower low. So quite a different pattern before it then took off again and formed new all-time highs. This is much more of what I expect to see with the S&P. I expect that we're going to see some sort of reaccumulation zone. So if we show this as a reaccumulation zone, and the way that this first fall, the volumes, the ranges of the candles, all those sort of things will give us an indication of the duration of this reaccumulation. So this is what I expect to see. This is, I think, what the market is telling us at the moment. And that's the scenario that I'll stick to until the market shows me something different. But as I said, I'll keep you abreast of that. Now let's look at some of the other indices. So the NASDAQ has really picked up again. This is the QQQ, the ETF covering the NASDAQ. And you can see the trend remains extremely strong, and we've had a real acceleration in the NASDAQ as well. Of course, new all-time highs, and we'll see something similar happen in the NASDAQ as well. Now, the small caps weren't left out either. The Russell 2000 has really rocketed higher, new all-time highs there. And whilst not quite as strong as some of the other indices, you could see there was a real acceleration over the last couple of days of last week. Now the US dollar, certainly weak and very weak on Friday, and it would appear that we are going to test, sorry, just extend that out. It would appear that we are going to test this trend line and or this key support level. So that's key support level there, just under 90. That level's been in place there, picking up these highs from 2009. That's been in place for probably 2 years. I've been showing this chart, haven't changed any of the support and resistance levels, and we've broken below this low, and we did it emphatically in the last 2 days of last week. As I said earlier, I can't explain it. It defies logical examination for me, and I can only explain it through the lens of the fact that the euro is going up more strongly than the US dollar. So there you have it. Now, just while I'm here, let's look at the Australian dollar. So we got down to 75, but now we've shot back up to 79 again on the Australian dollar. Very surprising. Let's look at the Australian index. Despite the strength in Wall Street, we've managed to, at least for one thing, we're holding above the 6,000 point level, which was key support and resistance. But it certainly did finish the week pretty miserably compared to what was going on overseas. So not much else to talk about with the Australian market, I'm afraid. So many are forecasting a weak US dollar in 2018. A lot of people sort of jumping on that bandwagon, and I often look for that sort of contrarian situation. So I wouldn't be surprised short term if we see a little bit of a bounce back in the US dollar. Now the ASX 200 ended up losing 52 points, and I won't restate what I've been saying over the last few weeks and months about the Australian market and the top 50 or the top 100 stocks. I just think it's one of the least productive parts of the global market where you could be. And the strength remains in small caps, small cap technology, small cap resource, although there's a lot of speculation in there in the resource sector, but that's where the action is in Australia. Turning now to precious metals, gold was $18 higher with the weakness in the US dollar, up to $13.39, so it's had quite a big rebound. So quite a bit about the currency, but also I think there's probably a little bit about people eyeing off the potential for inflation. But whatever it is, gold still needs to get above $1,400 to set a new uptrend. And the thing that still fails to excite me about the gold market is that the sector indices GDX and GDXJ are still not showing much strength. I would have expected, because they tend to lead in both directions, that we would have been seeing a lot more strength in some of the major stocks. Now, some of the smaller gold stocks are doing quite well, but certainly that has not flowed across into the majors at this point in time. So if you compare that, for instance, to the energy sector, which I'll do now, it really is chalk and cheese. So let's just take a look at. So we'll start with the gold market. So there was gold on a daily basis. So it was only the 12th of December. We were trading down at 12.41, and now we've stacked on virtually $100 since the 12th of December. So it's been quite a strong rise. But if we take a broader view on the weekly chart, you can see that we're still within this big wedge pattern that's really been under formation now since December of 2015. And we've really got to break above 1380, call it 1400 to signal a renewed uptrend. And GDX, there's really not a lot happening there. That's GDX on a weekly. So the majors are not joining in this rally to any significant extent at this stage. By comparison, let's look at XLE, which is the sorry, not in that workbook. So let's look at XLE. So if you compare this with GDX, you can see quite dramatically different. They're both coming out of bear markets, but the difference between XLE, once it broke out of this reaccumulation zone, so here's our reaccumulation zone through here. So we had an initial surge, reaccumulation, gather some strength, and now really rocketed away. XLE has run from under 70 to now almost be at 78. GDX has done nothing remotely of that sort of performance. So amongst the commodity space, really quite a lot of underperformance. Copper stocks are doing well. So yeah, big difference. So copper was steady at $3.20. Crude oil was sharply higher to $64.30. So we've well and truly broken out of that resistance zone that we had at around 61, 62. And we saw really strong performance across the board in the energy sector. Earnings growth forecasts are huge. Some of them well over 100% growth in earnings coming off a low base. So we should be expecting to see significant momentum, and we're certainly getting it at this point in time. Inventory levels continue to fall, and that's what's fueling this rise in crude oil. And of course, the currency is not hurting either. There's the spot copper chart, fairly flat on the week, but there's the crude oil chart. You can see it's really shot up in the last week or two. So wrapping it all up, there is absolutely no reason to suspect that 2018 is not going to be another excellent year. There's just too many signals that are all lined up pointing in the one direction for that not to be the case. But we are now getting into a stage where we're getting deviations well above the mean. In 2017, that didn't happen. The market just ground higher all the time, but never really got ahead of itself. The market in the last couple of days, the indices have now started to get ahead of themselves, and therefore you've got to expect that volatility is going to pick up. And instead of 1 to 2% little pauses or pullbacks, we may see more of the 3 to 5% type of pullback. So under those conditions, it's really critical that you do a couple of things. First of all, entry is important, so you need to let the opportunities come to you. Have a large enough number of opportunities that you can just sit and wait and buy on your terms. The second thing is that sector and stock selection is critical. Really important to be on the stocks that are the leaders, because that's where the institutions go. No point in going into sectors or stocks that have got a good story, but they're not leading, because the institutions aren't interested until it starts to get a resurgence. But look, what is important is process. And for all the golfers out there, you'll excuse me, I'm a golfing tragic. For the golfers out there that watch some golf, you'd be aware that the world's #1 golfer, Dustin Johnson, is almost unbeatable at the moment. And when interviewed about his success, he said it was just all the hard work on process. And his view was that if I get the process right, then the outcome will just take care of itself. He wasn't concerned about the outcome at all. He just knew if he put in the work and established a process that was repeatable and stuck to it, then the outcome would take care of itself. And I just can't recommend that approach more strongly to you. Portfolio analyst this week, I'm going to be introducing a local innovative stock that may not have come across your radar. In fact, I'd be surprised if it had. And also some more on managing the trade, on how to take profit. So if you haven't been across Portfolio Analyst and you'd like to try it for a couple of weeks on a complimentary basis, then you can find the links to that with this video. So that's it for this week. There's my contact details, and we've got a public holiday on Monday in the US, so it'll be a shortened week. But we've got earnings season really ramping up, so that'll be very interesting to see how that goes. That's it for this week. Cheers.